This one investing lesson made Warren Buffett his first billion. In fact, this lesson is the reason why Buffett is one of the richest people in the world, and why Berkshire is one of just 7 companies with a market cap of over $1 trillion. But the craziest part is that Buffett didn't learn this from his mentor, Ben Graham. No, rather, he learned this lesson from Charlie Munger. It all began with a disagreement over a company Buffett wanted to avoid, but Munger was obsessed with. This company changed Buffett's life, but for us to truly understand the importance of this business, we have to look back and see how Buffett was investing before meeting Charlie. You see, nearly 80 years ago, long before most of us were even born, Buffett was already hustling. As a young teenager, he ran a pinball business, delivered newspapers, and was making decent money doing all this. Ambitious and full of big dreams, he applied to Harvard, but they rejected him. This turned out to be a blessing in disguise, because after the Harvard rejection, Buffett decided to enroll in Columbia Business School. And that's where he met Ben Graham, the man who would change his life forever.
It was Ben's ideas that sent me down the right path, and then a year or so later, I very belatedly applied to Columbia University, and Dave Dodd let me in, and I got to know Ben personally when he was my professor in the second semester there. And when I finished up, of course, I said I'd go to work for him for nothing, and he said I was overpriced, and he probably was right.
Buffett learned the ins and outs of value investing from the father of value investing himself. But Buffett's perception of value investing wasn't quite what he considers it today. At the time, Buffett believed that true value investing is buying companies for less than what they're worth, without any regard for quality and longevity of the business. Even though this was a good strategy to make a quick buck, this short-sighted investing style soon got him in a lot of trouble. We'll get to that in just a second. In 1956, Ben Graham decided to retire and close up his partnership. By this time, Buffett had saved up $140,000, or $1.48 million now. So he decided to move back to Omaha and create a partnership where he raised around $105,000 from his friends and family, $1.1 million in today's money. He charged no management fee, took 25% of any gains beyond a cumulative 6%, and agreed to personally absorb a percentage of any losses. At this partnership, he employed everything he knew about value investing by then to find profitable investments.
If I hadn't read that book in late 1949, I'd have had a different future. It instantly clicked with me that what he was saying made sense, and then the chance to study under him and under Dave Dodd too. It was a different experience, but it was hugely helpful. It shaped my professional life.
Like I said earlier, even though now Buffett doesn't think highly of cigar butt investing strategy, at that moment it was working really nicely for him. By 1962, Buffett's partnership, which had begun with just $105,000, was worth more than $7 million. That's a mind-boggling 101% average annual return. But in 1962, Buffett did make an investment that he considers to be his first big mistake, and that mistake was buying Berkshire Hathaway. Buffett found Berkshire just like he was finding all his other investments at the time, looking for cigar butts. Berkshire at the moment was a struggling textile maker, during a period when the textile industry as a whole was on a decline. But the company was at a trading price that was too attractive to pass up for Buffett. He started buying the Berkshire stock at $7.60 per share, while the actual book value of the company was $19 per share. Even though it was not a good business, Buffett wasn't going to pass up an opportunity to buy something that's priced at less than half its book value. Effectively, he spent $7.60 to make $19. At the beginning, it was just another investment under the Buffett partnership umbrella. During his research before buying, Buffett had also learned that Berkshire management had a habit of repurchasing shares through tender offers. Whenever they made any money, they would use that money to buy back the stock. Most of the time, money wasn't even profits from operation, rather money that would come from selling off assets like textile mills. In 1948, Berkshire had 11 mills, but by 1965, they sold off 9 of them and used the money to repurchase the stock. This was definitely something that caught Buffett's eye and was one of the main reasons why he decided to buy Berkshire stock. Later on, Buffett actually met the Berkshire management and the CEO, where the CEO agreed to buy back Buffett's shares at $11.50 per share. But when the tender offers went out, the price was only $11.37.5 per share. Because of this price difference, Buffett felt cheated and decided to buy control of the company and oust the current management. Now, that's the popular story at least. But according to Buffett himself, there may be some details missing there. Important details. Hear it for yourself.
1962, and I was running a small partnership, about $7 million. They call it a hedge fund now. And here was this cheap stock, cheap by working capital standards or so, but it was a stock in a textile company that had been going downhill for years. So it was a huge company originally, and they kept closing one mill after another, and every time they would close a mill, they would take the proceeds and they would buy in their stock. And I figured they were going to close. They only had a few mills left, but they would close another one. I'd buy the stock, I'd tender it to them, and make a small profit. So I started buying the stock, and in 1964, we had quite a bit of stock. And I went back and visited the management, Mr. Stanton. And he looked at me and he said, "Mr. Buffett, we've just sold some mills, we've got some excess money, we're going to have a tender offer, and at what price will you tender your stock?" And I said, $11.50. And he said, "Do you promise me that you'll tender at $11.50? And I said, "Mr. Stanton, you have my word that if you do it here in the near future, that I will sell my stock at $11.50. I went back to Omaha, and a few weeks later, I opened the mail.
Oh, you have this.
And here it is, a tender offer from Berkshire Hathaway. That's from 1964. And if you look carefully, you'll see the price is 11 3/8. He chiseled me for an eighth. And if that letter had come through with 11 1/2, I would have tendered my stock. But this made me mad. So I went out and started buying the stock, and I bought control of the company and fired Mr. Stanton.
Based on what Buffett just said, it doesn't seem like there was any agreement with the CEO. It was more of the CEO just asking Buffett's opinion, and the CEO was under no obligation to actually follow the advice to the T. Nevertheless, Buffett had bought the controlling stake in the company and removed the current management. Buffett spent around $8.3 million to buy 49% of Berkshire. Luckily for Buffett, while he was studying the company, he was able to find an exceptional manager in Ken Chase, who was able to take over after previous management and get the company finances in order. Under Ken Chase, Berkshire's profit grew unexpectedly for the next 2 years due to cost-cutting and cyclic uptick in textile business. After 2 strong, profitable years, the textile business started to decline significantly from 1967. This is when Buffett started deploying the textile profits and equity into other businesses. One of the first companies Buffett bought under the Berkshire umbrella was National Indemnity Company, an insurance business. This was the beginning of the insurance giant that Berkshire would become nowadays. By 1970, Berkshire was making around $4.7 million from its insurance business and only $45,000 from textile operations. Buffett's side investment had already taken over the company, and the end of Berkshire as a textile business was near. But even at this point, Buffett was still looking for cigar butts, dying or struggling companies that were selling for less than book value. But by now, it was getting increasingly hard for Buffett to find these cigar butt companies during the roaring stock market of the 1960s. In fact, he even wrote to his partners explaining this situation and saying that he's considering leaving investing and pursuing other interests. It wasn't yet clear to Buffett, but he either had 2 choices. Either he reinvents himself as an investor to continue investing, or he had to leave investing altogether, because his old ways weren't going to work anymore. Clearly, you guys can see cigar butt investing wasn't going to get easier in the future. But I don't want anyone to think that Buffett was struggling by any means. In the last 14 years, Buffett had turned the initial $105,000 into $104 million. That's an insane 64% annual rate of return for 14 years. He was already a very rich man and would have likely continued to be a very successful investor, even if he continued to look for cigar butts. But if he had done that, we would probably still be saying that Buffett's that place where you can get all you can eat for one price. Luckily for all of us, in 1972, Buffett had the chance to buy a company that was different from cigar butts. In fact, it was quite durable. It was none other than California's famous See's Candy. But you know what they say, it's hard to teach an old dog new tricks. Buffett ended up rejecting this opportunity. The owners were looking for $30 million, while the book value of the company was around $8 million. Buffett, until this point, considered everything above book value too expensive. He was buying dying companies for 70 to 80% of the book value and getting a 64% return, making these safe bets. So when a company was asking for even $1 above book value, Buffett was quick to dismiss it. Luckily, Buffett had one friend who wasn't afraid to tell him to his face that he was wrong. That friend was none other than Charlie Munger. Since meeting, Buffett and Munger were heavily influencing each other's investment philosophy. In 1972, Buffett shared with Munger how he had an opportunity to buy See's Candy, but decided to pass on it. At this point, Munger's investment capital was a lot smaller than Buffett's, meaning he couldn't buy See's Candy even if he wanted. And boy did he want to buy this company. Munger believed $30 million to be a bargain price. Munger understood something about See's Candy that Buffett had missed entirely. He realized even though it was selling for way above book value, it was actually worth way more than the asking price. You see, book value only takes into account what's tangible, but sometimes a company's true value is hidden in something that's intangible, and that's brand value. Even though brand value doesn't show up in the accounting statements, its value is in the billions for some companies. A good way to visualize this is to take two identical shirts, but one has no logo and the other has Supreme's logo. There are customers paying $25 for one shirt and $1,200 for Supremes. Basically, people are willing to pay insanely high prices just for Supreme's brand. Charlie took this concept to Buffett and explained why it might be worth paying up for a brand like See's Candy. Eventually, they agreed on a $25 million counteroffer. Luckily for them, the owners accepted it and Buffett just made his biggest purchase. A purchase that would be life-changing and career-changing. Buffett and Munger were also able to take advantage of the company's untapped pricing power. Here's Buffett explaining how they increased profits at See's.
Basically, my partner Charlie and I really decided whether there was a little untapped pricing power there. In other words, whether that $1.95 box of candy could just as easily sell for $2 or $2.25. If it could sell for $2.25, another 30 cents a pound was $4.8 million on 16 million pounds. Which on a $25 million purchase price was fine. We didn't do any, we've never hired a consultant in our lives. Our idea of consulting is go out and buy a box of candy, and eat it. But what we did know was that they had share of mind in California. I mean, there was something special. Every person in California had something in their mind about See's Candy, and overwhelmingly was favorable. They had taken a box, Valentine's Day and given it to some girl, and she'd kissed him. If she'd slapped him, we'd have no business. But as long as she kisses him, that's what we want in their mind. See's Candy getting kissed. And if we can get that in the minds of people, we can raise prices. And I bought that I bought it in 1972. We've raised every year. I raise the price on December 26th. I raise it the day after Christmas, so that everybody, because we sell a lot at Christmas. In fact, we'll make $60 million this year. We'll sell 30 million pounds, make $2 a pound. Same business, same formulas, same everything. $60 million still doesn't take any capital, and we'll make more money 10 years from now. But of that 60 million, we make about 55 million in the 3 weeks before Christmas. And our company song is "What a Friend We Have in Jesus." I mean, it is. It is a good business. But the important thing about that business is that, think about it a little. Most people don't buy boxed chocolates to consume themselves. They buy them as gifts. Somebody's birthday. More likely, it's a holiday. It's Valentine's Day, single biggest day of the year. Christmas is the biggest season by far. But women buy for Christmas, and they plan ahead and buy over a 2 or 3 week period. Men buy on Valentine's Day. They're driving home. We run ads on the radio, guilt. The guys are veering off the freeway right and left. And they won't dare go home without a box of candy when we get through with them on our radio ads. So that Valentine's Day is the biggest day. But can you imagine going home on Valentine's Day, and our See's candy is now $11 a pound, thanks to my brilliance, and and let's say there's candy available at $6 a pound. But do you really want to walk in on Valentine's Day and hand, your wife's got all these favorable images of the See's candy over the years, and she sees you, and that's the way she thinks of you during the rest of the year when you really behave kind of badly. And you walk in and say, honey, this year I took the low bid, and then hand her a box of candy. It just isn't going to work.
This company turned into a cash cow that provided Buffett with funds to buy other companies. As of 2022, See's has returned more than $2 billion of pre-tax profits to Buffett, an insane 8,000% of the original $25 million price. This cash has helped Buffett buy other businesses that, in turn, have themselves produced large profits. But it wasn't just the cash from See's that helped Buffett build his empire. It was the lessons from this success, too. One could argue that the lessons were worth more than the $2 billion in cash See's had returned to Buffett. One of the biggest lessons was learning about brand value. Had Buffett not realized how to value the brand's name, he would have continued buying cigar butt companies that were dying. Not that he would have failed at making money, but he would never become the Warren Buffett we know today. He never would have invested in companies like Coca-Cola or Apple, both of which have been a huge part of Buffett's and Berkshire's success.